This is Randy Finney with Right Side of the Chart, and today is Thursday, February 25th, 2021. This is video number 2, and I'll try to get just some of these chart images out to you guys, either in this post along with the video or maybe in the comments section below. I am aware that some of you are working or just don't have the time for the longer videos, and I'll do my best to get some chart images out. But it helps to talk through. There's just so much I want to go through. This video I don't think will be as long as the last one, but here's what we're going to cover. Some of the things that I've highlighted recently, such as Treasury Bonds, crude oil, the dollar, euro, and the VIX. All right, so I'm going to start out with bonds because I think there's a trade to be made. Today I took a starter position. That means initial lot in ZN, the 10-year Treasury bond futures, and I'm going to tell you why. And think there's an opportunity there. And there's also ETFs that you can trade bonds with if you don't trade futures. All right, this is the 30-year bond. Well, I'm going to start out with the very long-term chart. This is a monthly chart, one I've covered many times over the years, but not recently. So again, part of that theme in the video today on the stock market was long-term. So for those of you not aware, Treasury bond interest rates peaked back in the early 80s. Yeah, that was Jimmy Carter leaving, Reagan coming in, hyperinflation, everything, and they've been in a secular bear market since, meaning interest rates. So that means rates have been falling and bond prices have gone up because bond prices and rates are inversely. Remember that throughout this video. When I talk about buying a 10-year bond or a 30-year bond or whatever, ETF or futures, to go long Treasury bonds, you're betting that the rates are going to fall because there is an unmistakable inverse correlation. It's not an on-off. It is a direct correlation at all points in time. There is a one-to-one or direct correlation between the bond prices and rates, an inverse correlation, that is. One goes up, the other goes down. So this was a natural trend. You can see, and I've always had a price channel on here, a well-defined price channel, but then something started happening in recent years, and it happened during the financial crisis back in '08 when the markets were melting down. Is when the Fed, these are the Fed's rounds, the various rounds of QE that took prices artificially below. This was just a natural, the economic cycle, everything going on. Around the world, we had just declining rates, just like we had rising rates before then, hyperinflation, or inflation, I should say. And then boom, boom, boom. This is the Fed coming in with their bazooka in 2008, buying bond, pushing yields artificially lower below that channel. And you can see each time yields want to snap back and try to go back to their natural place, back above the top of the channel, but we continued to overshoot the bottom. And then this is where, instead of pulling out the bazooka, they launched they went full-blown nuclear strike on the market, printing money and doing things that they just have never done before at that magnitude. So that was the Fed's nuclear option to COVID. But like everything else, and like I think ultimately will happen with the stock market, the harder you bring something down below, and think of this like a rubber band. I mean, this is a natural price channel for Treasury yields. That harder the snapback is going to be, and that's what's happened. And you can see every other time that the Fed pulled rates down artificially below that channel, we snap back to the top of the channel ultimately. So that's where we're probably headed over time and then beyond. If that inflation trade that I'm talking on, and it's certainly been the trade recently, even though the Fed's in denial, but we see commodities roaring. Again, that would be your longer term target. I need to extend these trend lines. There we go. Extend right, make it yellow, and let's match. I just have alternating trend lines. I have a purple one there, but there it is. So that's where we're probably going, but let's step down now. And this is a macro view, long term. If we go down a little bit more granular, and not still a long-term chart. This is a weekly chart. Here's where we're at now, and this is why I'm doing the video. 2416, to me, a big resistance level. I just jumped down to a weekly chart, but we're still going back now. This is 2012. Major reaction low there. A little momentum fueled overshoot, and that strong soft went right back above and then retested that level. There was another whip below, but we gained it and we held it again, and then we gapped down. That was all she wrote. We went down, back test, couldn't hold it, and then of course the Fed came in as well. So there's a lot of natural market forces here, but then the artificial forces, excessive measures by the Fed. But then this is just, it's again like almost like gravity. Things are going to come back to their natural point where they should be. Now, again, the Fed can step in and do things here and there, but I just want to say this, make it very clear. This is a rally, an overbought, I'm sorry, a very overbought rally into resistance. This is the percentage that TYX is trading above its 40-week moving average. Never in history has it, at least going back, into the 90s, has it traded that overbought. There's the RSI at the 76 level, overbought. Let's just look at the last few times it was that overbought right here. I'm gonna grab my arrow tool, overbought, and here's what happened. Right here, overbought, and here's what happens. So you gotta get the picture. Get overbought. There's not a lot of upside in rates from there. There's usually nothing, but usually downside either right away or shortly after. So there it is. So there's the case to short treasuries. Where would I go? I'd watch TYX for a pullback to at least this trend line. That's minimum, but that's what I think we'll probably get right there. And then you can see longer term resistance levels and a larger, more important trend line there. Okay, TNX you can trade. Oh, by the way, TYX, what I was just on. Now again, that was a 30-year yield. If you're going to use an ETF, you want to use TLT, that's the Treasury bond, the 20 to 30 year long bond, tracks long bonds. And if you want to trade the 10-year, IEF is the ticker. This is TNX. I'm focused on the yields because the yields are pure. This is what, professional bond traders, they're going to look at the charts of the Treasury yields. They're not, and or the futures. They're not going to look at the ETFs. ETFs are just tracking, doing their best to track those bonds. But here it is, TNX, very good level. This is again a weekly chart, major reaction low in 2012. In fact, this is a cleaner level. Look at those three distinct tags. Here, I'll zoom in so you can see it on the video. Again, this level right here, about 14, 17, contained all pullbacks in recent years for a long time until, everything hell broke loose right there, and until those COVID lows, we call it. And so now we're above it. You might say, oh, well, we broke out. That's breakout. I suspect because of this momentum, this has been a huge trade since we broke from that symmetrical triangle that I posted a month or two ago. It's been a big rally, one of the strongest runs, and I suspect it'll be a momentum-fueled overshoot. And so therefore, this is the one I have to take. So again, if you want to use an ETF, it's IEF, and you'd have a comparable trend line right here. Here, I'll show you IEF in just a second. We flip over to that IEF. There's IEF, and look, here's a case can be made. There's a reaction high right there, right? Another reaction high right there. Tested it again right there, and then boom, broke out, and now we're back testing. So this is a pretty strong case, I think, to step in here on Treasury bonds. And you can trade again the ETFs, the futures, because Treasury bonds, the moves. This is one. Look at that candle. That's the biggest red candle that we've had in a long, long time. But they're only down 1%. So what I always recommend, that beta adjusting position size I talk about, whereas if you're going with a volatile stock, take a smaller than usual position. In treasuries, it's the other way around. You can take a larger, double size position, double what you might normally put in SPY, because the moves aren't going to be as big, the daily price swings, and ultimately your price target, wherever that is. Where might it go? I think a bounce back to that trend line right there. That'd be a nice target. Again, just an initial target, maybe more after that. And what's nice when you buy a pullback to support that's oversold, like we are right here on the RSI, you can set a stop somewhat below and have a very nice risk reward. So I tend to take counter trend trades. I'm pretty sure most of you have figured that out by now. It's just my trading style. I like to catch tops and bottoms. Not for everybody, but that's one reason. It's because you can do it with relatively tight stops if you're wrong. All right. And then here's the daily chart. And I did put this out for a member about an hour or so ago. It looks like we're already getting the reversal since then. And that was, I'm sorry, in the comment section of one of the recent posts. I put up a chart on one of these. There it is. So boom, pull back to nice support. All right, 114.53. You can see its support here, here, and that reaction high right there. So there's the case right there for IEF. And this is what TLT looks like. TLT, my daily, I already showed you the weekly. Yeah, let's just focus on the weekly chart right there. I can see these reaction lows from back there. And again, I made the case more so on the interest rates that we start out with TYX. So there it is. Here's ZN. And let me go down to a 30-minute chart here. Those are 2-hour candles there, bars. Quite a reversal stick. There it is. Wow, yeah, looks like I grabbed it at a good time. I think that's a big reversal candle so far. Very oversold. At the time being, like I said, I'm looking at that trend line is really what I'm looking at for a bounce back in yields, looking at TNX. And I'll also look at this chart. But again, I want to get this out as a potential trade idea. I don't think the train's left the station. And this should correlate or coincide with my correction call in the stock market. You know, I've been pretty persistent and adamant on that. Maybe I'll be proven wrong, but you know, I told you today in the update I got out early that I thought this was the last chance, last objective long entry before we take out the lows and the recent lows and head down to the next target at 297. We were right there back testing this morning, and if you look at QQQ, there it was. So you know, got that chart out. Here's the open today right here. We ran up, back tested. So that was an objective entry, and boom, so far, you know, from high to low, the Q's dropped 3.72%. And again, maybe I'm wrong, but I think that's the last chance, just going from experience. You had a, you know, fall the first target, had a reaction. I expected a reaction. We had a reaction. It went up to about where I expected to go, and that's it. So when you get there, the initial reaction is all I try to game. After that, the next run down to that level will usually break, and we haven't taken out the lows yet, but we're close enough. You know, it is support until unless broken. But again, that's what the stock market's doing. So if we take that out, the Qs take out Tuesday's lows, I think it will then spill over or begin to spill over into the other sectors in the S&P 500, and then firm up the case for a bigger drop in the market. And therefore, we should see, especially with the extreme overbought conditions in treasuries, overbought. Treasury bonds, or I'm sorry, yields are overbought, the bonds are oversold. Gosh, it gets a little tricky when you deal with that inverse situation. So that you know, sets the stage for potential rally, but I need to say it is largely contingent, just like crude oil, which we're going to talk on in a second. I've been setting up the case for a correction in crude, but also said, you know, you're going to need to see the stock market go down, and we're going to need to see the dollar cooperate. You know, the stock market is at the SPY, the S&P 500, has a much larger component of energy stocks in it than the NASDAQ 100. And there's, you know, the benefit of the doubt trend line we're at right now. And so we need to see a little more downside on SPY. And let's do that. I already covered the markets extensively. Let's go to crude oil and take a look at what it's doing, and then we'll look at the dollar. So this is CL. The CL are crude oil futures. You can trade crude in many different ETNs. USO is a straightforward, the most liquid one. If you can't short USO because you're not able to shorten your account, there are inverse crude ETNs, and you can just do a Google search on that and find those. But here's the levels. I had this one colored blue today. That was my primary trend line. This was a bearish rising wedge crude. We broke down, back tested, back testing again. We're pretty much, as I said this morning, at the apex, back testing the apex of that wedge, with this minor trend line below right here, and that needs to go for the next sell signal on crude, or for a sell signal on crude. And that should take us to this secondary uptrend line right here. Reaction there, quite likely, not guaranteed. There's only a couple reactions on that line so far. And then ultimately down here to 58.89, 58.90, so we'll call it $59, give or take. Again, largely contingent on the stock market going a little bit lower. We're really close to those lows from Tuesday on the SPY and QQQ. A little more work, that should do the trick. Otherwise, like I always say, support is support until unless broken. Maybe the buyers step in here and foil everything, and wouldn't be the first time since the market bottom March lows. The stock market's had a voracious bid. But again, I like to see certain things such as negative divergence, for example, on the 60-minute time frame to end a correction. The last time we had that here, you know, there's a correction. It was highlighted when we broke this little bearish rise and wedge. It was your sell signal right there. First wave down, kickback rally, another wave, and double tested that level, went low, but then we put in positive divergence. That was the last divergent low, and that was a catalyst for this entire climb right here, and that ended with, clear out the lines, and this is NQ, by the way, if I didn't mention it, NASDAQ 100 futures 60-minute chart. That ended with a divergent high, little wedge. There was our sell signal breakdown. We've been walking lower since, but we need to take out these recent lows. In fact, there's pretty good support running from about 12,731 to 12,676. And now what concerns me, speaking of these divergences, if we get that another thrust down, then we just slightly undercut the recent lows. And the problem with that now for the short case is we're going to have, if it happens today or tomorrow, we're going to have positive divergence. That doesn't guarantee a rally, and then we need to confirm the divergence. But one of the signatures that a correction is in the early stages is if you get that potential divergence. In other words, the indicators are making higher highs at the point you make a lower low in prices, but then prices keep falling. It's called what I call burning through the divergences, and that's quite bearish. Even if you get a little confirmation, a little curl up in the MACD, PPO down here, you get positive divergence, but then it fails. That's when you'll probably see that the impulsive selling I've been talking about. I mean, today, sure, that's impulsive selling. That's almost a 4% drop from the highs, but I'm talking about on a waterfall type sell-off. If we can get just a little more downside, break that support level, burn through those divergences, have the S&P 500 and NASDAQ 100 break those recent support levels, that's where I think you'll see that kind of quick, sharp drop that similar to what we saw back in March. I'm not looking for a drop of that magnitude, at least not in such short order this time around, but it is possible. There's certainly all the ingredients are priced into the in the market. The put to call ratio, extreme bullish sentiment, divergences, everything else. Okay, so crude oil. Crude oil, if the market drops significantly, 5, 10 plus percent correction, I think crude's going to come down pretty hard. But we're going to need to see that because, crude and stock market are usually run together based on economic growth expectations. But one of the big factors, crude is highly affected by the dollar. Crude around the world is still traded in US dollars. So we have an inverse correlation there. So lately the dollar has been falling. We put in this divergent high back here, then we took out this trend line, and dollar's been falling. Although we did bottom back here. I made the case for a rally there. We certainly got a rally. Fell a little shy of my 92 target so far, but and again, this is not ideal to see it drop that close to where we bottomed, but with that being said, forget about what's happened. Let's look at what might happen going forward. What I'm looking at is some nice positive divergence. Again, like back here, we had negative divergence. Back here, we had positive divergence, a big divergent low, and that led to the biggest rally in the dollar in many, many months. And so there's the potential there as well. And we've also seen the dollar falling with treasuries falling recently. But again, so if this plays out, as I suspect it will, that should help treasuries. And that should also be net bearish for crude oil because when the dollar goes up, it'll take fewer dollars to buy a barrel of crude, and when the dollar goes down, it takes more dollars to buy a barrel of crude. All right, so there's the outlook of the dollar, and then of course there's E7, which are Euro futures. Coming right up, if I can find it. Here we go. And there's that 12236 resistance level defined by this previous reaction high here, as well as this reaction low and some reactions along the way there. We went up. We hit that just today earlier. In fact, I think I made a screenshot. Let me see. I can't find it. I thought I did. Maybe I was about to this morning if I didn't post this one already. But that's it. We had a little divergent high there. There was a divergence, boom, correction. Now we have an even bigger divergence high. It's off the same starting point. So those divergences have only grown larger. Failure and impulsive move down off resistance. And so if we continue lower, falling euro means a rising dollar. So there's the outlook for the dollar, the euro, and again, that all meshes with that crude oil chart. So if this plays out, crude and the euro are going to run together because remember, crude's inversely correlated to the dollar, but positively correlated to the euro. So that would be that scenario. So you want to see, if you're going to short crude, if you get a sell signal on crude, ideally you want to see the euro stay below today's high right there, that reaction high. And then finally, there's the VIX, highlighted recently, is setting up really nice for potential move. I think I did update this chart and give, let me see here. Yeah, we'll look at this one right here. There's a couple lines to watch, but let's see right here. This one's nice. You have, here's our divergence line. Divergence has been building. We're up today, but nothing big. I mean, that's 9%, but that's not a, it's a relatively par for the course on the VIX. And this is VXX, by the way, short-term futures, one of several ETNs you can use to trade the VIX. But there it is. There's your levels. Give you these two targets here. You could add the trend line in as well that I had. I'll do that. But I'm more of a fan of the horizontal levels on this one. And I will have to correlate that with the VIX, spot VIX. But 2168, should we get a little more downside and continue to firm up the case for the correction, I'm talking the equity markets, and if that's hit, that's going to be about a 38% gain from where we're at now, and if the next level is hit, that's about 52%. Again, a little more work to be done. And finally, we'll wrap up just looking at VIXX. This is the VIX spot index, and there's a clear level right here. I've been highlighting this for a long time here, this 20-ish, 2022-ish level. Very good support. You can see that on the VIX, especially recently. All pullbacks to that level have contained it, and that's where the rallies begin, off that level. It's not always right away, so we'll see. Now, if we break this and move down to the bottom of that previous trading range, it's all the way down here just below 12. This will most likely coincide with all these what I'm seeing as sell signals right now, and hopefully some more to come, is just being whipsaw signals. It just means there's just a ton of demand in this market, much more demand than supply as far as stocks go, and we're going to have some kind of blow off top. I don't favor that scenario. I'm looking the other way, position the other way, looking to add more if and as I get more sell signals. So this is the way I'm looking right now. And then when we look at the VIX, where might it go? Well, let me see. I have more levels over here. Yeah, I need to update this chart, but I always trade, if I'm trading those VIX ETNs or the VIX futures, I'll look at this one as well. These are just all potential points there. Again, I know this chart's busy, but it does show you, we had the divergence has continued to build. That's one thing I should have mentioned on this last one right there. Positive divergence as well. Nice clean divergence too on the VIX. Prices making these pretty much equal lows right there, with the indicators making higher lows. So it all comes together. Negative divergence on the indexes, positive divergence on the VIX, bullish, case to be made to go long treasuries right now, and market leaders breaking down. Apple, Tesla, like I talked about, just need a few more to join, and then that should spill over to the other sectors, the financials and other things that are holding up, and give us the correction. Otherwise, like I said, goes the other way. These are the levels to watch. So the bottom line is, stops can be relatively tight on everything, on shorts on the index, longs on the VIX, and if you're a bull, buy the equity market or buy the dips. We're at support. I got to be careful shorting the VIX, but let's just leave it at that. So those are trade ideas for you, the VXX or the other ones. There's plenty out there, or the VIX futures. And then we'll wrap it up. Somebody asked for an update, but I put that on the homepage today, and under on the homepage under one of the comment sections. They asked about XOP, and I said that's going to be contingent on crude breaking down. Crude and energy stocks go hand in hand, and crude's been going up. So if I get the breakdown on CL, I get the moves in the dollar and the euro I'm looking at, and the stock market, then most likely you're going to see a sell signal trigger or a breakdown here. What I need to see on XOP is a break back down below that 80.35. I think this is quite possible, a little momentum fueled overshoot. So a move back down will be a false breakout, and it will also take out this minor trend line, and then that should take XOP back to at least that 72 first target, and if not, maybe the 63.51 and possibly more. So a lot of ifs. And I'm going to end the video here. We've gotten some of those check marks already for shorting the market, and we have several other check boxes that are still empty that need to be checked. And the more that we get checked, the better, the stronger the case for a 10+% drop. A significant drop, maybe 20% or more. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart, and I will be out of the office certainly tomorrow, but I might not be leaving town until tomorrow morning, and if that is the case, then I'll get something out in the morning. Otherwise, I might have to leave tonight. It's still up in the air. All right, wrap it up here. Have a great day, guys.